Okay, so it is 12:01. I think we're going to get started. So the first thing I want to tell you is that I have to give you a little disclosure. This is being recorded. So we do send out the recordings after to all the people who have registered. So if you don't feel comfortable being on camera, you can shut down now, because then we're going to start obviously from here on. So you can certainly come disconnect and we'll send you the recording. If you are staying on, just know that you're going to be recorded. So that's our disclosure. My name is Michelle Fitzpatrick. I'm joined here by John Starling today, my associate down in North Carolina, and we are with Northern 1031 Exchange. We are a wholly owned subsidiary of Northern Bank based in Woburn, Mass, and we are qualified intermediaries for 1031 exchanges. Today, we're going to be talking about navigating real estate exchange, and we're going to do 10 steps for success. So it should be a fairly quick webinar today, just because we're going to just go step by step, everything that you're going to expect in chronological order of how to complete a 1031 exchange. John, do you want to do a quick introduction of yourself before we get started on the slides?
Thank you, Michelle. It's a pleasure to be with everybody today. And, we've been doing exchanges for about 24 years now. We like to say almost a quarter of a century. And we've been helping thousands and thousands of people save millions and millions of dollars in taxes and helping them grow their real estate investment portfolio. And it's just been a pleasure to work with lots of New Englanders and people from all up and down the Eastern Seaboard. Looking forward to helping you if a need arises.
Great. So let's get started. So we're going to give you just a quick overview of what 1031 exchange is and a few of the rules, and then we're going to go right into our steps. So what is a 1031 exchange? A 1031 exchange is an IRS tax code. It allows you to defer your capital gains taxes when you're selling an investment property, as long as you use those proceeds to purchase a replacement property. And there are going to be guidelines within that. So you have to make sure that you follow those IRS guidelines in order to complete a successful 1031 exchange. John, do you want to talk about the taxes that people would face if they chose not to do a 1031 exchange?
Yeah, so the code, Michelle just gave you a nice understanding of the code. The code says you don't have to pay this tax. And what is the tax? Well, a lot of people say, well, it's capital gains tax, so I only have to pay 15%. Wrong?
Wrong.
Yeah, so there's a lot of taxes, and you can see them here on this chart. Federal tax, 15 to 20, depending on your tax bracket. If you're in the highest tax bracket, then you pay capital gains tax of 20%. If you're in any of the lower brackets below the highest bracket, then your federal capital gains tax is 15. You have depreciation recapture on the money that you have deducted over the years as you've owned the property, and you have to recapture that depreciation at 25%. Then you've got the federal NIIT tax, which is 3.8%. That's just another federal tax that you will have to pay if you're making more than $250,000 per year combined between you and your spouse, and including the purchase or the selling price of the property that you are selling. And then there's the state tax. You've got the 5% Massachusetts state income tax. And then Massachusetts has instituted last year a new tax of 4% on everything above $1 million. They call it the millionaire's tax. Welcome to Taxatussets.
I was just telling Jim before we started this webinar this morning, I was just telling him that I read something that the majority of the people that fall into the millionaire's tax in Massachusetts are people that are selling a one-time asset. So it's not actually millionaires, it's really the people that are selling assets like this. So it's kind of unfortunate. It's a little bit of a bummer. So I like to put this slide in here just to kind of give people a visual of what it would look like when you're selling a property. and what the tax looks like. So it helps you understand how you determine what your tax basis is and your profit and the actual tax. So in this scenario, we have the original, somebody purchased a two-family house 10 years ago. They bought it for $500,000. They put capital improvements in of $50,000, but then they depreciated it for the last 10 years, and they depreciated, $15,000 a year. So their depreciation is $150,000. This brings their tax basis down to $400,000. So now they're going to be taxed on everything over and above the 400 when they sell it. So the sales price is now $1.2 million. They take out their tax basis. They take out the cost of the sale, which is the realtor fees, the attorney fees, the transfer taxes, the recording fees, things like that. That comes to $80,000. Now they have a capital gain of $720,000. Of that $720,000, they're going to have a $37,500 in recapture depreciation. So you take the 25% on the $150,000 that they depreciated over the 10 years, and that's $37,000. That's a big nut for a lot of people. A lot of people have held their properties for a long time, have depreciated properties for 20 years. So the depreciation recapture is usually pretty substantial for most of our clients. In this instance, I took the $720,000, I times it by 20% to get the $114,000 in the federal tax. The 3.8% of the 720 is $27,360. And the Massachusetts state tax, we didn't add the millionaire's tax in this one, but the state tax is $36,000. So all total on this $1.2 million sale, they're going to pay $215,000 in taxes. That's pretty substantial. And that's why when we are talking about 1031 exchange, our tagline is always preserve your profits. So preserve this $215,000 and build your wealth. You're better off putting this $215,000 into real estate and into another piece of property rather than paying the tax, and it's gone forever.
Exactly. And Michelle, we keep threatening to change this slide, and we need to put that on our list.
I know.
Because, over the course of these last 5 years, if you would have bought a property for $500,000 10 years ago, that property probably be worth about $3 million or $4 million instead of 1.2. And you can see where the tax would have gone
Substantially
had
up.
we used a more realistic
Right.
slide.
John, why don't you take this one?
Okay, so basically 1031 allows us to, this is just kind of like the little steps involved. We, as the qualified intermediary, what is our function? Well, we serve in the middle here. If you'll see my tie, I'm not wearing a tie, but anyway, there I am with a tie. And so we are the qualified intermediary, and we engage with you as the taxpayer, and then we sign an agreement together to handle your exchange, and then you sell your property to a buyer. It's deeded directly from you to the buyer, even though we take assignment of the contract once you've sold it to the buyer so that we can take the proceeds from the sale. So basically what you've done is you sold the relinquished property to us, and then we have sold it to the buyer, so we get the proceeds. Now, under 1031, remember, you have to have a person to swap with or exchange with, so we become the person that you exchange with, and then you go out and find a seller that's willing to sell you a replacement property, that purchase property over there, and you see that bag of money. So what we do is we fund the money to the seller so he can deed the replacement property to you. So basically what we're doing is buying that replacement property from the seller, and then we're selling it to you, creating an exchange between you and us, even though you've actually sold your property to a separate buyer and you bought a replacement property from a separate seller.
Yep. So that's called a delayed exchange using a qualified intermediary. The time frame's really important here. You have 45 days to identify from the time that you sell your relinquished property. Your clock starts ticking. You have 45 days to identify this replacement property. But you have 180 days total. Again, from this sale, you have 180 days total to actually purchase this replacement property. So now we're just moving on to the steps, and we'll break that little cycle, that little graph down, we'll break that down into 10 steps. So step one, you're going to be selling your relinquished property. And you're going to do this as you normally would. You're going to go out and you're going to find a realtor that's going to be super aggressive. You're going to find somebody that's going to be able to market your property and get highest purchase price for you. You're going to enter into a purchase and sale contract just as you normally would. So you're going to accept your buyer's terms and offers. The attorney or the realtor is going to draft that purchase and sale agreement. And then you're going to accept a deposit. The deposit's going to typically go to, again, either the broker or the attorney. And they're going to hold that in escrow. So that is step one. You can do all of those steps without starting an exchange. And then we move on to step two. John, do you want to take step two? Because this is the most important part of your entire exchange process.
So it says that the qualified intermediary is a neutral third party, and neither the attorney nor the agent, the real estate agent, can serve as the qualified intermediary, nor can your CPA. So you have to have an independent third party to serve as the qualified intermediary, and that, of course, is our function, what we do. And you enter into an exchange agreement with the qualified intermediary before closing the relinquished property. How many calls do we get a month, Michelle, from people that say, hey, I just closed my property and I want to do a 1031 exchange because I don't want to pay the tax?
Too many. My attorney just told me about it today and I closed yesterday. My realtor just found out about it and told me about it.
Yeah.
Yeah. Those are the worst calls.
We don't have any recourse. I mean, we can't help you unless, like if you closed it yesterday and you haven't gotten the funds yet and the attorney's willing to cooperate to redo the settlement statement and have it re-signed by all parties and then redisperse the funds, then we could do it if you hadn't taken receipt of the money. But once the money has been received by the exchanger, it's just too late. And the only alternative then is to just pay the tax.
Yeah, it's a little bit of a long shot too, John.
Yeah, it is a long shot, especially if there's financing involved from the sellers, from the buyers. Side. If the buyers get in financing, it's impossible. So what do you do for a qualified intermediary? Well, you want to choose somebody that has experience. Safety of funds is held in the QI is paramount. In other words, what's going to happen with your money? It's not going to you, so it's going into a qualified intermediary's hands. That's why we feel like you can feel more secure because you're putting it into a bank's hands. Whose name is going to be on those funds? And that's very important because we always put the client's name and the client's social security number so that money is totally and completely protected from any creditors that might come about in the future. What are the requirements for the deposit and withdrawal? How are you protected from from your funds being withdrawn to be used for other sources? Does the QI have a state-of-the-art fraud protection plan in place? Is the QI audited by independent third-party auditors? And is the QI a member of the Federation of Exchange Accommodators? The FEA, Federation of Exchange Accommodators, is our trade association. It would be like dealing with a person that has a real estate license, but they're not really a realtor. They're not a member of any association. Therefore, they have no ethical responsibilities, no ethical requirements, and they don't have any supervision. The Federation of Exchange Accommodators has a very strict guideline, very strict ethics requirements, and that is one assurance that you can be dealing with a reputable QI. Now, fortunately this year, and it's been a privilege for me to serve on the board of directors of the Federation of Exchange Accommodators, and I'll be serving for the next 3 years as a director there. And so we are highly involved in our own trade association. The independent third-party audits are required through the banking system, and when you deal with a bank-owned QI, you are dealing with the highest form of protection of your funds.
Yeah, and I just want to jump in. I've been with the bank John and I have both been with the bank for 11 years, 10 years, 11 years now. I've been in banking for 20 plus years, in real estate for longer than that. So dealing with a bank is very different than dealing with other types of businesses. We are under dual control and scrutiny with every step of the way. So your funds are protected. And, we get calls pretty regularly where people will say, oh, I found a QI online that will do it for $250. Just be careful. Not all qualified intermediaries are created equally. And the reality is that it's not a super highly regulated industry. So really anybody can hang up a shingle in most any state and say that they're a qualified intermediary. So just do your due diligence, whether you choose us or somebody else.
Absolutely. And Michelle, I heard we got a distinction and a new accreditation from the, what do you call it, bank.com?
Oh, bankrate.com. Yeah, we're a 5-star rated bank. So, yep. So step 3, you're going to assign the contracts. So just as John stated in the beginning, is that we assign, the exchanger will assign the contracts, the purchase and sale agreement will be assigned to us. And we use a relinquished property assignment agreement. We draft that contract that will state that you are assigning the contract to us, and we're going to be working to purchase a replacement property and doing a 1031 exchange as the qualified intermediary. And we will reach out to the closing attorney and ensure that they have the assignment agreement available, and that's how they'll draft the settlement statement with the closing instructions that we provide them. We also provide, at that time, wiring instructions. So the wiring instructions will be sent directly to the closing attorney. At the closing attorney will send the proceeds directly to us. So you never touch the funds. You'll never be in constructive receipt of those funds, which again is a requirement, or a restriction, I guess is what I should say. And then step 4 is the relinquished property sale. John?
Title is conveyed directly at the closing. The title company or the attorney will transfer the title directly from the seller to the buyer. The proceeds will come to us, and then we're on to step number 5.
Perfect. And we handle all that. Just so you know, we're kind of handling that. Once you engage us as qualified intermediary, we're handling that all on the backside. We're reaching out to the attorney. We're drafting all the contracts. We're the ones that are, taking charge of that. So
instructing the attorney how to fill out the settlement statement so it complies with IRS requirements.
That's right. Yep. So we do all of that on your behalf. And then step 5, the wires come to us. We hold the proceeds. So like John said earlier, you cannot have constructive receipt of the funds. So you can't come into the bank and say, I want to withdraw the funds. They're mine. We are holding constructive receipt. The bank accounts are opened by us, so you don't have to do anything where you don't have to go into the bank or do anything. We will open the bank accounts and we are controlling them for the duration of the exchange. And then just as John stated, we hold those every exchange that we do. We hold each proceeds in segregated subaccounts. So again, they're in our exchanger's name, they're in their tax ID number. We are the signers of the account. So they're not commingled with anybody else's funds. And then we give an accounting at the end to show how the funds have been handled through the duration of the exchange.
So identifying the replacement properties, you got the 45 days and the 180 days Michelle talked about earlier. Taxpayer must identify the replacement property in writing by midnight of the 45th day. This is a hard deadline. The 180th day is a hard deadline. The IRS has no extensions other than if there is a presidentially declared disaster area in your area. We get those quite frequently in the southeast from hurricanes, not so much in the northeast, occasionally from a northeaster, but it's rare we get extensions on the 45-day identification period. IRS will not allow an extension because of any kind of hardship. So even if the exchanger dies, the exchanger's estate must complete the exchange or pay the tax. Okay,
Yeah,
Michelle.
if the house burns down, there's no extensions. If the seller backs out or the buyer backs out, there's no extension. So it's certainly something to consider, which is why having replacement property with backups on it is important. And one thing to note about the 45-day identification, you can identify properties up until the 45th day. Once the 45th day has ended, you cannot change what you've identified. So if you only identify one property and that property burns down, you're out of luck, unfortunately. You may not be able to complete your exchange. However, if you identify multiple properties, you identify the one that you want with a couple backups, and your ideal property burns down, you can certainly go on and use your backup properties as replacements. No changes.
Okay.
And these are, I forgot that I threw this one in here because I wasn't going to get too detailed, but there are only 3 ways that you can identify replacement property. And you have to choose one of these 3 ways. The most popular way is the 3 property rule. And that states that you can, the taxpayer can identify 3 properties, and it doesn't matter what the value of those properties are. That's, again, most common. Most times people are selling one property, purchasing one property. They put their dream property on a couple backups, and that's what they use. The 200% rule is used when people are diversifying their properties. They're selling one property and they want to buy 5. Well, the 3 property rule won't work because they have to identify 5 properties. So the 200% rule allows them to identify an unlimited number of properties. However, the aggregate value of all the properties cannot exceed 200% of the value of the property that was sold. So if they sell one property for $1 million, they can identify, under the 200% rule, they can identify $2 million worth of properties. So they can identify 10 $200,000 properties if they want. So that's a little restrictive when, it's a little restrictive.
So Michelle, I'll just add the 200% rule was created so that people that want to diversify can buy multiple properties. The 3 property rule is for a person that's going to sell one and buy one.
Mm-hmm. Exactly.
The 200% rule is for a person that's going to sell one and wants to diversify and buy many.
That's right.
Maybe 3 or 4 or 5 properties. So the 200% rule was created for that. The 95% rule was created for those people that want to buy a portfolio of properties, many properties. So you sell one and now you want to buy a portfolio from one seller that has 20 single-family houses in it. Well, you can't use the 3 property rule because you're identifying 20 single-family homes. You can't use the 200% rule because it's a lot more than $2 million. In your example, you're selling one for $1 million. You could only, under the 200% rule, you could only identify up to $2 million worth of replacement properties. So the 95% rule is for those people that are really being they're wanting to grow their wealth fast, and they're taking all of the proceeds from their relinquished property and using that as a down payment and highly leveraging the rest of the purchase price of the portfolio of many properties.
Perfect. Thank you. Somebody just asked a question if the federal tax payment is deferred or completely gone, and the answer is it's just deferred. So you're kicking the can down the road. And I'm going to just show you, I'm going to go back to that slide and just show you really quickly before we go on to the next step. But in this example, the tax basis is $400,000 and they're selling for 1.2. Let's say they purchase a replacement property for $1.2 million, the same amount as what they sold for. Their tax basis in their new property is going to be $400,000. So when they go to sell that new property 5 years, 10 years away from their 1031 exchange, they're going to pay taxes on everything over and above that 400.
Michelle, I'm just going to say, why would you ever cash out? You're always going to be in real estate. Hence, what we like to say to people is swap until you drop.
Swap until you drop. I love that.
Yeah, because I mean, you might not own the same types of real estate over the course of your lifetime, but you're always going to stay invested in real estate because you know that real estate has brought you a good income and a good living and has increased your wealth over the course of your lifetime. And why would you ever get out? I mean, what are you going to do? Go buy an airplane or maybe you're going to go buy a big motor yacht? I don't know.
Well, that's the thing too. I mean, how long is it going to take somebody to get back to whole when they pay $215,000 in taxes? How long is it going to take you to get back that $215,000 before you start earning interest on that money again? If you take it out of real estate,
you're digging out of a hole, and that's why 1031 is so valuable. Is you're not having to dig out of a hole. You're having to add. You're just piling on.
Yep, 100%. So
when your real estate that you're left with when you pass gets a stepped up basis to your heirs, and they pay no tax. They could sell your real estate investments the day after the funeral, and they would pay no tax. And so that's why we say swap until you drop.
That's right. And we do a webinar every year on 1031 exchange and estate planning, and specifically talking about that topic, talking about the powerful tool of having your heirs having a stepped up in basis. I mean, that's a great estate plan. So more to come on that one, because we will have literally a whole hour-long discussion. We typically bring in an attorney to talk through that as well. And I love that. That's one of my favorite topics.
You can see why we're so passionate about this, because real estate is for now and for the future and forever. I mean, it's just tax protected. It's the way to grow your wealth, because the forefathers had the insight to know that if you owned real estate, you made a better citizen. Yeah. You became a better citizen in this country. And so they gave you all of these opportunities to grow your wealth through real estate. And that's why it's 1031 has been in the code and preserved for almost as long as the code has been in existence.
That's right. That's right. Over 100 years now.
Yeah.
Sorry, Ann, you asked a question, and you asked, under the 3-property rule, can a property you're buying be worth more than 200%? Yes. 3-property rule, it doesn't matter what the value of the property is, so it can exceed. You can, if you're selling for $1 million, you can identify a $5 million property, you can identify a $500,000 property. It doesn't matter.
You can identify $5 million properties.
That's right. Yep.
Yeah.
So yes.
Great. Thank you.
Step 7, contract to purchase a replacement property. So this is the same thing. You are going, after you start your exchange, you've closed on your relinquished property. Your next step would be to purchase, to get into a contract to purchase a replacement property. So you're going to go shopping. You can use a realtor. They're going to draft the contract for you, and you can sign that contract. And then you're going to assign that contract over to the qualified intermediary using a replacement property assignment agreement. And we, again, will send those directly to the attorney in preparation for the closing. So I put this in as step 7, and a lot of people ask me the question, can you get into a contract with a replacement property prior to selling your relinquished property? And the answer is yes. So I was going in kind of chronological order. That makes sense. However, a lot of people, most of our exchanges today, are getting into, once they have a contract on the property that they're selling, once they have a contract on their relinquished property, they're going out and actively shopping for replacement property. You can get into a contract to purchase replacement property prior to selling. That is fine, as long as you do not close before.
Once you have that contract, then you're going to send it to us so that we can take assignment of it. We can fill out the assignment agreement, have you sign it, and then send it on to the closing attorney along with closing instructions so that he'll be prepared to close on that contract for that replacement property.
Right.
Okay, next.
So moving along, we are at step 9. You want to do this one, John? You want me to take it?
Closing on the replacement. So the QI will transfer the proceeds from the exchange account to the property seller. Well, generally we don't send it directly to the seller. We send it to the seller's attorney. In title company states, we send it to the title company that's closing on behalf of the buyer. And the title will be conveyed directly from you as the exchanger to the, wait a minute.
No, from the seller. Yep,
yeah,
from the seller
okay.
to the exchanger.
Right. Yep. Okay. So it's important to note that if the 180th day falls on the weekend or a holiday, the property must be conveyed to the exchanger prior to the 180th day. That's just if you found yourself in a situation where you were coming to the end of your exchange period. Generally, if once you sold your relinquished property, you're going to contract to buy a replacement property right away, and the seller's not going to want to wait until the 180th day to close it. They're going to want you to close it right away, just like you're going to want to close it right away, because you're going to want to get your money out of the exchange account and get it invested in new real estate so you can start making money on that real estate.
Perfect. And this is not something that we are talking a lot about today. And again, it's something that we have an entire exchange webinar on, but there does need to be a continuity of both title and taxpayer. So however the exchanger held the property, whatever title name they held the property in is how they need to take title to the replacement property. Typically, there are going to be exceptions to the rules. However, we'd like to see that taxpayer is the same taxpayer that sold the property is the same taxpayer that's purchasing the replacement property. So there's more to come on that with another webinar, but today was our step-by-step. So finally, we are in step 10, and this is our last and final step. So we, as qualified intermediaries, we do not file your tax returns for you. We do not report the 1031 exchange to the IRS. All we're doing is providing you all the documentation you need to file an 8824 form indicating or telling the IRS that you have reporting to the IRS that you have done a 1031 exchange. So
we give you a nice little package by email, a package of PDF documents that you just forward right on to your CPA or your accountant that's preparing your tax return. And that little set of documents gives him everything he needs to file that one-page form called an 8824.
Right, which I think I have an example of it here, so I'll kind of hop onto that in a minute. So a couple things important to note when you file your taxes. Your exchange will need to be reported in the year that you sold your property. You sold the relinquished property. So if you sell in December of 2024 and you don't buy until April of 2025, you have to report your tax. You have to report the exchange on your 24 tax returns. Now, if your sale or your purchase happens or your 180th day or whatever falls after the tax filing date of April 15th, and you have not closed or purchased that replacement property yet, you need to file an extension for your tax returns. So that's a pretty important thing to note. The 8824 form is the IRS form that you report, and I'm going to show you that in a moment. And, taxpayers can file for themselves or have a professional CPA help them with that. In the 8824 form, the whole, and this is hard to see, but you can very easily Google it and pull it up. But the whole top half is really asking questions about your relinquished property, how much you purchased it for, how much your improvements were, the date that you purchased it, how much you depreciated it for, a lot of information that we wouldn't have anyway on the property that you sold. And then it will start to ask questions about the property that you purchased, when you purchased it, how much you purchased it for, when your 45th day was, when your 180th day was, and then we provide all the details for that part. So that is your 10 steps to a successful exchange. Does anybody else have questions? I see one other question in the comment. The 1031 exchange concerns both property owned by individuals and owned by companies. Yes. So the question was, can you do a 1031 exchange if the property is owned by either a corporation or an individual? Yes, both. You can exchange whether it's owned in an LLC, in a trust, with partnerships, as individuals, however you want.
Here's another question about debt on property. What about debts on property? Well, if you have a mortgage debt, then the mortgage has to be satisfied. The debt has to be satisfied at the closing of the relinquished property. So now we're getting less cash, but you still have a requirement to buy a property of equal or greater value if you don't want to pay any tax. If you buy down in value, then you have to pay tax on the difference. But when you go back to the debt piece, that really means that if you're selling a property that has, let's say you're selling that $1 million property, it has $200,000 worth of debt against it, then you're only getting $800,000. And so now you're going to have to buy a replacement property for $1 million. So you're going to have to finance another $200,000, or you can pull 200 out of savings or from some other place where you have cash, so that you don't have to do the financing if you don't want to. But generally speaking, you would replace debt with new debt, and you would replace equity with the equity from the sale.
John, I have a couple more questions too that are in the question and answer section. So the first question was, can you do a 1031 exchange if the property is owned in a single owner LLC? And the answer is yes. And what's nice about having a single member LLC is that is a single member disregarded entity. So in the eyes of the IRS, the LLC and the taxpayer or the individual are one and the same. So when you do a 1031 exchange and the property is owned in a single member LLC, there's a little bit of flexibility there with purchasing the replacement property. The replacement property can be purchased in that same LLC. It can be purchased in the name of the individual, or it can be purchased in another single member disregarded LLC or entity. So there's a lot of flexibility because that taxpayer is one and the same as the LLC. The second question, actually there are two questions. How long do I have to own the property I'm selling to be able to take advantage of a 1031 exchange? You want to take it? So there's no hard and fast guidelines from the IRS on how long you have to own the property. So the IRS doesn't stipulate a time frame. All they're telling you is that you need to have had the intention to own the property for long-term, investment purposes. So there are always examples, and there are case studies that have shown people that have held properties for a very short period of time and have been eligible for a 1031 exchange. And there are other ones that they've held properties longer and, the exchange was disallowed. So they look to what your intention was. Was your intention when you purchased the property to have held that property for long-term gain?
Or was it just to flip the property? If your intention was to flip the property, then you would have put it right back on the market again with it and listed it with a realtor. That does not bode well, because 1031 is not eligible, or is not you can't use 1031 if your intention is to just flip properties. You have to pay ordinary income tax on those sales.
Right, those are considered short-term gains. So the answer that we typically give people, QIs usually are prudent and say hold property for 2 years. If you can,
but you don't have to. If you buy a
you don't have
property
to.
with the intention of renting it, somebody comes along and offers you a $200,000 or $300,000 profit, a nice, handsome profit, no matter what. You have the right to re-exchange that property again and flip it, even if it's only 3 months you've held it for.
People ask me how they can prove intent too, and I'm like, well, that's kind of easy. You can sign a long-term lease with with a tenant. You can sign a mortgage that has a 5-year prepayment penalty. There are a lot of different ways that you can show that you intended to hold a property for long term. And so the next question is it deferment of the taxes? If so, when is the tax ultimately paid? So we already answered this. Yes, it is a tax deferral. It is not a tax exemption. So if you swap until you drop, if you swap until you die, the taxes do not get paid. Your heirs get a stepped up in basis. If, however, you decide to ultimately sell one of your properties, sell your property out of the exchange, you're going to pay taxes upon any sale. And so I think I saw a couple more questions pop up in the chat. Let me answer those. Let me look at that one. We talked about the debt. So regarding the debt, the question was, and John, you answered it already. What about debts on the property? And is the debt paid by the 1031 or the closing attorney? So the debt is going to be called at the closing. So the attorney will pay off on the settlement statement. It will list all of the expenses, including the debt that needs to get paid off. The bank will be paid off at the closing, and then we get whatever is left after, whatever's remaining. That's what comes into the exchange. The next question is, sorry, John, did you have any?
No, I was just going to say, if anybody wants to unmute their mic and ask a question, that's fine too. If you're typing.
Sure.
Yeah.
Can one sell a property in a state and purchase one or multiple properties in other states? Great question. These are all really good questions, by the way. Yes, you can do a 1031 exchange in any of the states, any of the 50 states. So you can sell in one, you can buy in another.
Is there a good resource for like kind properties, or how you can determine what's considered like kind?
That's the beauty of 1031 exchange. Like, John, you're muted. Like kind is very broad. You can sell any property, any type of asset that is either rental or held for investment purposes or business use, and purchase any other type of property that's held for investment or business use. So if you're selling a multifamily, you don't have to buy a multifamily. You can buy a commercial property, you can buy a single family, you can buy a condo, you can buy land, you can buy a boat slip, as long as it is deeded property that you are going to hold for investment purposes.
Okay.
Yep. Let's look at it this way. Like kind means investment property for investment property. So non-like kind would be an investment property for a primary residence, an investment property for a second home. Does that make sense?
Yeah, I just want to make sure, like, for instance, like in the example of like I have a building I'm going to be looking to sell, and it's like a commercial slash residential rentals or whatever. We'll call it mixed use. But let's say I want to exchange that for a piece of land that, I don't know, I was going to do something with investment wise, but it may not have an income to it. Is that a problem, or?
It's just another piece of investment property, any kind of real estate.
Okay.
As long as you don't live in it, or it's your second home.
Yep.
Because there are a lot of people, we've done a ton of raw land where people have owned like farmland. They haven't done anything with it. They haven't rented it. They haven't done anything, but they've exchanged it. So.
And then you guys might not know, I can ask my attorney, but the, if you have like a lot of my properties are in like a single member disregarded entity, can you swap those into a trust without an issue, or is that generally?
As long as it's Go ahead, John.
Yeah, as long as you're the beneficiary of the trust, I mean, you're still the same taxpayer. That's the key.
Right.
Same taxpayer that sold the relinquished property has to buy the replacement property. If you hold the title in a single member disregarded entity, then it's disregarded. It's you as the taxpayer. If you hold it in a trust where you're the initial beneficiary of the trust, then the trust is a pass-through entity, basically. You see?
Gotcha. So the entity, the property that you're purchasing though has to be of equal or greater value to what you're selling.
Yes, and you can't buy from yourself, so you can't buy from another one of your LLCs or a trust that you've set up. You have to buy from a non-related third party.
Okay. All right. You guys answered all my questions. Thank you.
Good. These are great questions. And we do, like I said, we do webinars every month, and we try to vary up the topics. So we talk a lot about estate planning. We'll get into ones with reverse exchanges and improvement exchanges. And so a lot of these will be covered as well. Sorry, Marlene, go ahead.
And can I turn my residential home into a 1031 exchange?
If you rent it out for 2 years leading up to the exchange, you can, yes.
Okay, perfect. Thank you.
You have to rent it for at least 2 weeks a year for the 2 years prior to the sale.
2 weeks or 2 consecutive years?
You have to rent it for 2 weeks per year for the 2 years immediately prior to the sale.
Oh, okay.
That's a minimum. In other words, you have to have rented it out for at least 2 weeks a year for each of the 2 years prior to the sale. And you have to have limited your personal use to no more than 2 weeks per year, unless you're there for the purpose of maintaining the property. And then those weeks don't count.
Okay, thank you.
Good question.
Yeah, these are great questions. I was honestly, John, I thought that we were going to come into this webinar today. I'm like, we're going to be off in 20 minutes. That's it. That's going to be a quick one, step by step, and we're going to be done. So you guys have had really great questions. So we appreciate the conversation. And if there's any other questions that you have, again, feel free to unmute, or you can pop it in the chat or in the Q&A. John and I will stay on for a little while longer. Anything else? Like I said, sorry, go ahead, Marlene.
I'll be calling you and making an appointment. Is that okay?
Of course, yep. So obviously our phones, the phone numbers that are up there, they ring directly into our cell. So feel free to give us a ring.
I know David Moynihan said, I'll make sure you say I refer you. Okay.
Oh, love Dave. Thank you. That's very nice of him. I've done a lot of exchanges with Dave. We go way back from my 20 years of banking. So
yeah.
I think there's one more. Oh, I think we got them all. Good. So yeah, feel free, Marlene, to reach out if you guys have any other questions. Again, we'll stick around for a few more minutes. We appreciate everybody joining. Thank you so much for spending your lunchtime with us. And I hope everybody has a wonderful day. Thank you.
Thank you. Likewise.
Thank you.